Hello everyone, my name is Gabe Selby and I'm the Lead Research Analyst at CF Benchmarks. And in this video, I'm going to take you through our insightful journey into the world of Bitcoin. We'll start off by going over what is Bitcoin, how does it work, and then we'll take a deeper look into its investment thesis before finishing things off with how it can be a complementary asset to a diversified portfolio. So what is Bitcoin? Well, it's the world's first piece of digital collateral. Bitcoin is truly a revolutionary form of digital currency that was first proposed in 2008. And unlike traditional currencies that rely on central banks or governments, Bitcoin operates as a completely decentralized system. Its protocol is governed by strict cryptographic rules that limit the supply to just 21 million coins. Bitcoin enables fast, global, decentralized transactions without any financial institution or intermediary, and the peer-to-peer nature of Bitcoin allows people to send or receive payments directly, much like digital cash. As the first and largest cryptocurrency, Bitcoin pioneered the use of groundbreaking technologies like the blockchain, public key cryptography, and proof-of-work consensus. So how does Bitcoin actually work? Well, like we said earlier, Bitcoin is fully decentralized, and it operates on a peer-to-peer network. And without the need for banks or government oversight, here's how it works. The Bitcoin network is made up of a global network of computers called nodes. These nodes power the Bitcoin blockchain, which is a public ledger that records every Bitcoin transaction ever made. When someone initiates a Bitcoin transaction, nodes called miners compete to package these transactions into blocks and add them into the blockchain ledger. Miners use specialized hardware to solve complex math problems in order to validate transactions and create new blocks. The first miner to solve the math problem adds the new block to the blockchain and receives newly minted Bitcoin as a reward. The mining process secures the network as well, and it also processes these transactions. Every node on the blockchain has a copy of the blockchain ledger, and this decentralized structure means that no single entity controls the blockchain. Instead, consensus must be reached through the mining process. To spend Bitcoin, users broadcast transactions from their wallet to addresses to the network. Miners then verify if the person sending the Bitcoin actually owns it. Once consensus is reached, the transaction is added to the new block. This irreversible recording system guarantees that Bitcoin cannot be double spent. The blockchain permanently records the movement of funds from one wallet address to another, giving Bitcoin real value as a digital currency. So in summary, Bitcoin harnesses peer-to-peer networking, cryptographic security, and blockchain technology to create a decentralized currency outside of any bank or financial intermediary or government. The mining process is there to incentivize network security and transaction verification. This allows Bitcoin to function as a digital money without any centralized oversight. Next, we'll talk about Bitcoin and its investment thesis. So Bitcoin's investment appeal really lies in its unique properties. Like we said earlier, it's decentralized, it's immune to inflationary pressures due to its cap supply, and it's seen as digital gold. Unlike traditional currencies, Bitcoin is not subject to any monetary policies that could erode its value. Its limited supply and halving events make it an attractive long-term investment for those seeking alternatives to traditional asset classes and as a hedge of economic uncertainty. Up on the screen, we highlight 4 of the key characteristics that make Bitcoin an attractive investment opportunity. First, it's sound money. Second, it's diversification. Third, its return profile. And fourth, its universal adoption or network effects. So next, we'll take a deeper dive into each of these 4 properties highlighted here, starting with its sound money characteristics. So what makes Bitcoin an attractive store of value? Well, unlike fiat currencies that can be printed without limitation, Bitcoin has a fixed supply of just 21 million coins. The scarcity is enforced through programmed halving events that cut the block reward for miners in half every 4 years. These regular halvings reduce Bitcoin's inflation rate over time, as seen by this chart. After the next halving, expected in April 2024, the mining reward will decrease from 6.25 Bitcoins to just 3.125 Bitcoins per block. Each halving constrains new supply entering circulation. Historically, halvings have catalyzed bull runs in Bitcoin's price as new supply decreases while adoption and demand continues to rise. Bitcoin's transparent and algorithmic monetary policy makes its cap supply predictable and immune to manipulation, which is different than gold, where Bitcoin supply is transparently auditable through its public blockchain, and unlike real estate, where Bitcoin is highly divisible and transportable digitally. These attributes strengthen Bitcoin's investment case as a digital hedge against inflation, especially relevant in today's climate of unprecedented money printing. So in summary, Bitcoin's programmed scarcity enforces transparency and predictability of new supply over time. When coupled with accelerating institutional and retail adoption, Bitcoin's verifiable scarcity makes it an attractive contender as the world's universal store of value in the digital age. Next, we'll talk about how Bitcoin protects purchasing power over longer periods of time. So, over the past decade, Bitcoin has outperformed most major asset classes in maintaining purchasing power. As shown in this chart, and according to data from Bloomberg, Bitcoin's 10-year returns have exceeded those of equities, bonds, precious metals, and crude oil. And while only equities has managed to outpace US inflation over this period from a traditional asset class peer group, Bitcoin has massively exceeded headline CPI figures. Meanwhile, these stereotypical inflation hedges like gold, oil, or inflation-linked bonds have actually failed to keep up with CPI or consumer prices over this time period. These advantages in maintaining purchasing power are most clear over multi-year time frames. Bitcoin may see interim swings or drawdowns, but when viewed in terms of a 5-year or 10-year investment window, Bitcoin's track record illustrates its potential as an inflation-resistant asset amid unprecedented money printing worldwide. But of course, past performance does not guarantee future results, and Bitcoin's capacity to preserve wealth over the long term relies on continued adoption and demand to outpace new supply from mining. So while risks still remain, the data historically shows Bitcoin's promise as a non-sovereign store of value in the digital age. Now we'll talk about how Bitcoin can facilitate diversification in a multi-asset portfolio. As Harry Markowitz once stated, diversification is the only free lunch in investing. By allocating capital across various asset classes that are not highly correlated, investors can reduce overall portfolio risk without sacrificing return potential. Bitcoin is an attractive diversifier because its price has shown a low long-term correlation to traditional asset classes like equities or bonds. And this is illustrated by periods where Bitcoin rallied while stock markets have actually declined, more recently last year. However, Bitcoin has seen some shorter periods of elevated correlation, especially to growth stocks or the tech sector. So Bitcoin is not completely detached from the broader financial markets, but over the longer term, it can show this lower term correlation. So when we zoom out and look at a multi-year timescale, Bitcoin returns have actually not been in lockstep with stocks, bonds, or gold, or any other asset classes. This suggests that Bitcoin can improve portfolio diversification for longer term holders. So adding an allocation to Bitcoin can allow investors to tap into this asymmetrical return profile while the lower correlation moderates overall portfolio risk levels. And this is the benefit of diversification that Markowitz was talking about. So of course, Bitcoin's upside comes with significant volatility that may not be suitable for conservative investors. And with any asset, there are clear cycles of highs and lows. Bitcoin and equity correlations also deviate over time. But when viewed through a longer-term strategic lens, Bitcoin diversification can pay off for suitable investors seeking to optimize risk-adjusted returns. So next, we're going to talk about Bitcoin's diversification benefits in context to its history. In Bitcoin's early years, one of its major investment advantages was its near zero correlation to equities, bonds, or other fiat currencies like the US dollar or the euro. As the chart illustrates, prior to 2020, Bitcoin's 90-day rolling correlation to the Nasdaq 100 index hovered near zero. This meant Bitcoin's price moved independently of major tech stocks or growth stocks. Likewise, Bitcoin showed minimal correlation to bond yields or the dollar. However, during the COVID pandemic, this marked a regime change where we saw extensive stimulus packages or monetary policies that boosted financial assets across the globe, including cryptocurrencies. Bitcoin's correlation to equities, yields, and the dollar began to change. But in 2022, high inflation has triggered a decoupling. Central banks have reversed course and tighten monetary policy considerably. This has caused Bitcoin's correlation to revert back towards its pre-2020 averages near zero. This also may suggest that Bitcoin is in the process of rediscovering its roots as an uncorrelated asset. While interim correlations may arise during regimes of coordinated monetary policy or fiscal policy, Bitcoin's long-term independence is starting to reemerge again. And if these trends in correlation continue, Bitcoin may provide a way for investors to diversify beyond traditional inflation hedges like gold or commodities. With its transparent supply and decentralized properties, Bitcoin offers a digitally native hedge unlike macroeconomic forces shaping legacy markets. Time will tell if Bitcoin's near-zero correlation pedigree endures amid rapidly evolving global markets, but its recent decoupling from stocks, bonds, and fiat currencies is a promising signal for investors keen on Bitcoin's potential as an uncorrelated store of value. So the next property that we're going to dive into is Bitcoin's return profile, or its return asymmetry. An asymmetrical return is appealing to investors because they offer more potential upside than downside. This skews the risk-reward profile favorably. As the chart shows, Bitcoin has historically exhibited an asymmetrical return profile when compared to traditional asset classes. In bull markets, Bitcoin's gains have significantly exceeded its losses in bear markets. When looking at this table, Bitcoin's best monthly gain was over 451%, and its worst monthly gain was just 41%. So in this example, the upside capture really dwarfed the downside. This contrasts with other assets here on this table like commodities that tend to see more symmetrical return profiles over market cycles. Meanwhile, stocks and bonds also do not consistently exhibit the same degree of upside asymmetry as Bitcoin. So what makes Bitcoin have this asymmetrical return profile? We can attribute this to its fixed supply, its growing network effects, and explosive adoption curve. These attributes allow for dramatic price appreciation in bullish macro environments, while at the same time, Bitcoin's floor has been established by production costs or its utility as digital money. This has limited the maximum drawdowns when compared to its upside. So while past performance does not guarantee future results, Bitcoin's historical asymmetry highlights its potential as a high upside investment. And even a small allocation to Bitcoin in a diversified portfolio could significantly boost returns without necessarily adding proportional amount of risk. So the next topic that we're going to discuss in our Bitcoin journey is its risk-adjusted performance. Many critics like to point out the elevated levels of Bitcoin's volatility. And what we want to discuss now is that investors have historically been rewarded for these heightened levels of volatility. And for this, we're going to use the Sharpe ratio. So what is the Sharpe ratio? Well, the Sharpe ratio measures an investment's excess return per unit of risk taken. It's calculated by taking the return minus the risk-free rate and dividing it by the standard deviation of the returns. A higher Sharpe ratio indicates stronger risk-adjusted returns. And as our chart shows, Bitcoin has historically had a higher Sharpe ratio when compared to traditional asset classes, especially over longer time frames. For example, Bitcoin's 5-year Sharpe ratio is approximately 1.42. This means that for each unit of risk taken, Bitcoin generated 1.42 units of return above the risk-free rate. Meanwhile, if we look at equities over the same 5-year period, this was only 0.65. So Bitcoin essentially provided over twice the risk-adjusted performance when compared to stocks. This highlights Bitcoin's upside potential relative to its volatility. Despite those sharp interim swings, Bitcoin's long-term risk-adjusted returns have been superior based on the Sharpe ratio analysis. In fact, no other asset class has consistently exceeded Bitcoin's risk-adjusted performance over multi-year periods. This is largely due to its asymmetrical return profile, which makes Bitcoin uniquely appealing to certain investors as a portfolio diversifier. So, of course, we need to highlight that past performance is no guarantee of future results, but Bitcoin remains a new asset class and carries a significant amount of risk, and these risks have been rewarded in historical standards. So, the fourth and final principle of Bitcoin's investment thesis that we're going to highlight and talk about is its universal adoption, or network effects. So what are network effects? Well, these occur when a product or technology becomes more valuable as more users join the network. Bitcoin exhibits several types of positive network effects in 3 different categories. First being liquidity. Bitcoin trades on numerous centralized or decentralized exchanges, and as more and more traders interact or exchange Bitcoin, we'll see the liquidity pool continue to grow, and the transaction and friction between Bitcoin will continue to shrink, making it more and more valuable. The second thing is acceptance. Growing Bitcoin adoption encourages more merchants or businesses to accept it for payments or a source of collateral. This again expands Bitcoin's utility. The third thing is its security. Bitcoin's decentralized network gets more secure as more miners and nodes join to validate transactions. A larger network means more security. So, these network effects become more and more self-reinforcing. And as the chart shows, the number of unique Bitcoin addresses has continued to grow exponentially over time, which reflects its expanding user base. The more users generate more network activity, leading to greater liquidity, merchant acceptance or utility, and enhanced network security. And in turn, these benefits attract even more users. Despite market downturns, Bitcoin's network effects have persisted, highlighting its resilience. Bitcoin offers fundamentally new monetary properties. It provides scarcity and censorship resistance. And as more individuals or institutions recognize its advantages, Bitcoin's network is likely to just keep expanding, and this growth makes the system more and more useful and secure for all participants. The final thing that we're going to be highlighting is, how does Bitcoin fit into a portfolio? Adding Bitcoin to a diversified portfolio can enhance risk-adjusted returns, making it an intriguing option for investors seeking a balance to traditional and modern investment strategies in an increasingly digital world. However, investors are still plagued with the question, what's the right amount of Bitcoin to add to a portfolio? Determining the right Bitcoin allocation involves balancing its upside potential with its downside risk. Bitcoin can enhance portfolio returns, but it also introduces some volatility. Looking at the past bear markets provides guidelines for right-sizing your Bitcoin allocation. For example, Bitcoin's largest drawdown was around 90% from its peak to trough. A 3% allocation would produce about a $2,700 portfolio loss on a $100,000 portfolio if we use that drawdown assumption. Or it would be about $2,400 if we used an 80% drawdown assumption. This demonstrates how a modest allocation can limit the downside risk exposure to a portfolio that size. Conversely, that 3% can provide substantial upside if Bitcoin continues to appreciate exponentially in the future. This asymmetric risk reward that we discussed earlier makes a small Bitcoin allocation powerful and compelling. Investors can choose to dollar cost average, which can further moderate the risk of accumulating a Bitcoin position over time, and this reduces the timing risk versus a single lump sum investment. In summary, limiting Bitcoin to a few percentage points of a total portfolio balances its return enhancements against downside risk. This is due to Bitcoin's non-correlation to other asset classes, maximizing diversification benefits while containing drawdown risk based on historical experiences for longer time horizons. Next, we'll show just how a strategic or long-term allocation will impact a moderate 60/40 portfolio over these various allocation levels over time. Bitcoin's asymmetric return profile can significantly enhance portfolio performance even at low allocations. Our analysis shows a 1, 3, and 5% Bitcoin position prorated in a 60/40 traditional portfolio can boost its returns without materially increasing the overall risk levels. This is because Bitcoin's long-term non-correlation to traditional asset classes provides diversification benefits that counterbalance its short-term volatility. Portfolio standard deviation does not materially start to rise until the Bitcoin allocation actually starts to exceed a 5% level. But the Sharpe ratios can increase anywhere from 8 to 40% with just a 1 to 5% Bitcoin allocation if we look at a 5-year period. So all this is to demonstrate that Bitcoin's ability to improve risk-adjusted returns thanks to that exponential upside potential during bull markets, and is also non-correlated to diversify away from interim volatility, can have a material impact on achieving a diversified portfolio's goals. Now, of course, past performance does not guarantee future results. but historically speaking, a modest Bitcoin allocation has significantly amplified returns without proportionally increasing portfolio risk. So, for suitable investors, strategically incorporating a small Bitcoin position, that can unlock outsized growth from an emerging asset class while still moderating the overall portfolio risk through diversification. Thanks again for joining us on our informative Bitcoin journey. If you want to read the full paper, be sure to head over to cfbenchmarks.com, where you can learn more about all of our latest research and insights.